Okay, here is a graph of the Dow Jones Industrial Average over 10 years, um, going back here to 2000 here. And this here up here is the Dow Jones Industrial Average over a 10-year period. And this down here is the monthly MACD, invented by Gerald Appel in 1971. It has this maroon line which has the direction of the market, and it has this blue signal line that crosses over. And in January 31st of 2000, before the dot-com bubble officially started in April, the Dow gave a sell signal January 31st of 2000. And then it didn't give a buy signal up until about March, April of 2003, long before any trend lines were broken. And so this MACD is a leading indicator of the market. It crosses over before the market actually gives a signal, and it crosses over before the upside before the market actually gives a trend line break as well. And we see here that in the subprime loan crisis in December of 2007, it gave a very timely sell signal with the Dow around 1300. And if you'd stayed out of the market during let's see, this is 3 years in here, it's about 3 and a quarter years in here, and about a year and a half in here. If these almost 5 years you'd stayed out of the market, you would have saved yourself a lot of grief. And one person said, you know, the best technique is to be in the market when it's going up and be out when it's going down. And this is something, this monthly MACD gives some very timely sell signals sometimes, and you can get out of, you can do this on stocks as well. Get out of the stock, like you can buy, Boeing at 30 and sell it at 90. And some of the stocks that are moving wildly during economic recoveries, like General Motors, Ford. This technique tends to work very well, using this monthly MACD to give you sell signals, and you get out and you wait for a dip and you get right back in. And so this is a very good technique. There's sometimes you should stay out of the market and sometimes you should be in the market. Currently, when we look at the market in 2013 here, 2013, the monthly MACD is accelerating to the upside. So the market is breaking out because hiring has improved a little, building materials are selling a little better, construction's a little better, home builders a little better, banks, insurance agencies, energy is a little better. So the market has broken out to the upside, and the monthly MACD is very positive. So we should definitely be in the market, and there might be some corrections like there were here in the past, but they'll tend to be minor corrections because the fundamentals that caused this crash, here you had some Alt-A and option arms loans that adjusted in here that caused this. Those are now that the loans are no longer resetting, very few are resetting still. The market is strengthening a little. Also notice that on this other graph here, that both the market top here in 2000, the government was raising rates. In 2000, we were at a 10-year high in interest rates. And here also, in 2006 and 7, the interest rates were the highest they were in 5-6 years. So typical market tops here tend to be marked by high interest rates. Both of these were marked by high interest rates, and the MACD was well above the zero line in both cases. One of the weaknesses of the MACD is that when the market just starts to break out many times, when it's fluffing around here very slowly, and the Bollinger Bands are very narrow, because you've got some very slow movement in here, the MACD tends to give you these whipsaws where it gives you a sell and it gives you a buy in here, and And even though the market really isn't turning to the downside, it'll give you false indicators like this. This is the number one reason that I use the monthly MACD. When I look at, like on this graph here, I have the monthly. This is just the same graph, just much smaller. I have the monthly, and then I have the weekly, and then I have the daily. And the daily is giving buy and sell signals every few weeks. The weekly is doing it every maybe couple months here, and the monthly is doing it much less frequently. So you can put these together, and as long as the monthly is positive, you can use the weekly as a buy signal, and you can also use the daily for much finer tuning. So that's the weakness of the MACD, is that when the market is moving slowly, it tends to give you whipsaw signals. So if you're like looking at a daily graph, you need to move to the weekly graph to get a better picture, to get less buy and sell signals. So I hope you liked the video. Have a nice day.